What's up guys, welcome back to InvestingPH. Now although our market has recovered quite a bit from its lowest point of 5,700 last year, it is still nowhere near pre-pandemic level. But on the brighter side, for us long-term investors, this is a great opportunity to buy great companies at a discount. So in this video, I'll be sharing with you the top 5 companies on my watch list that are still undervalued. By the way, if you haven't yet watched my previous video of the top 5 dividend stocks for 2023, then better watch it after this, as I won't be repeating the companies I've shown there in this video. And just a reminder, this shouldn't be used as a basis for your investing decisions. Please do your research properly before buying or selling any stocks. So with that said, let's head on to the first company, Robinsons Land Corporation or RLC. Now ever since the pandemic, the real estate sector was hit hard, which led to the stock price of most real estate stocks going down, and RLC is one of them. A quick look at their financials. Revenue had been growing consistently for the past 10 years, although it dropped in 2020, but they got up again and have now surpassed their pre-pandemic revenue. Same as in their net income, although their latest 12 months have yet to surpass pre-pandemic levels, but they are almost recovered. With this, they have a 10-year compounded growth of 11.83% in their revenue and 7.09% in their net income, which is still a good growth considering they have yet to pass their pre-pandemic level. And for their equity, even amidst the pandemic, they have continued to grow and actually even boosted their growth in 2021. They grew their equity by 23.73%, which is a huge jump for them. This takes their 10-year compounded growth to 10.75%. As to how well they're managing their debts, current ratio stands at 1.46, which is still within good range. Since I always look for this ratio to be at least above 1, this means they have 1.46 pesos of current assets for every 1 peso of current liabilities, which means they can easily pay up all short-term obligations with some to spare. And for their debt-to-equity ratio, this accounts for all their long-term and short-term liabilities in relation to their equity. They have a ratio of 0.68, which is very low. This means they only have 0.68 pesos of debt for every 1 peso of equity, which is well within good range. Moving to their dividends, they have a dividend yield of 3.4%, and they have somehow grown their dividends in the past years, although they dropped a bit in 2021 because of lower earnings, but they've managed to recover. And as to how sustainable their dividends are, they only pay 31% of their earnings, meaning their earnings can cover well what they pay to the shareholders. And for price valuation, their PE ratio is at 8.8, and if we compare this to their peers, RLC is a bit in the higher range since almost all real estate companies are still quite undervalued. And for their price to book, it's at 0.6, which means we are buying their equity at a huge discount. Just think of it this way, we are only buying their equity by 0.6 peso instead of its regular price of 1 peso, which is a 40% discount. Comparing it to its peers, as I've said, most real estate companies are still undervalued. And lastly, my computed intrinsic value for the company is 21 pesos, and with a 30% margin of safety, my buy below price or buy price is 14.7, which at the creation of this video, RLC is still trading slightly below my buy price. And by the way, if you're wondering as to where I got the graph for dividends, PE and price to book ratio is from Simply Wall Street. They have a ton of data for you that will help you analyze stocks easily, which can really help in building up a good portfolio. And if you're tired of looking for news if the company you own has released their earnings or dividends, then they have it for you as well. They update you on earnings release, dividends, insider buying or selling, and if the stock you own is undervalued. There's more, if you don't know how to compute the intrinsic value of a company, they have a computation for you from analysts and the DCF formula. But of course, this shouldn't be used as a sole metric to know if the company is undervalued or not. So these are just a few tools available on this platform. So if you want to try it out, they offer a forever free basic plan. But if you do want to avail their paid plan, which includes unlimited access to a bunch of tools, then if you use my link, you can get up to 40% discount. So what are you waiting for? Try Simply Wall Street. The next company is Ayala Corp or AC, a holding company that has a diverse set of holdings, from real estate, bank, telecommunications, energy, and a lot more. For their financials, revenue has been growing for the past 10 years, though they still have yet to pass their pre-pandemic level. And in their net income, same story as well, although they managed to recover quite well and are nearing past their 2019 earnings. Their 10-year compounded growth for the two is still quite good, revenue 8.34%, and net income 11.89%. For their equity, even amidst the pandemic, they still continued their growth. Their 10-year compounded growth is at 11.46%. As to how well they're managing their debts, current ratio stands at 1.94, which means they can easily pay up all their short-term obligations, and for their debt to equity, it's at 2.41, which is quite above my criteria. But remember, they also have a bank holding which can increase this ratio. Now I tried searching if they have data that doesn't include their bank holding, but I didn't find any except for their financial highlights, which state that their net debt to equity ratio in the first quarter of 2022 is only at 0.69. For their dividends, their yield is at 1.1%, which is relatively low. As to how well they can maintain this, they only pay 14% of their earnings to their shareholders. So this explains why they have a low dividend yield. As to why some companies only give out a small amount, there's a lot of reason, but one of them is they would rather reinvest their earnings to grow the business. For their price valuation, PE ratio is 12.6, which if we compare to its peers, is relatively on the higher end. And for the price to book, it's at 1.1, meaning we are paying 0.10 pesos more for 1 peso of equity. In comparison to its peers, they are equal to the average price to book in its industry, so still a decent range. Lastly, my computed intrinsic value for AC is 967.18, and with a 30% margin of safety, my buy price is 677.02. As of the creation of this video, AC is still trading below my buy price. Third company is Shang Properties. Just like other real estate companies, it was also affected hard by the pandemic. Now compared to the other companies on this list, this is a rather small company with only 12.33 billion pesos market cap. The company's businesses are residential, malls, offices, hospitality, and property management. For its financials, from 2012 to 2019, it had been consistent with its growth, but as with all real estate businesses, went down during the peak of the pandemic. Though their revenue recovery is somewhat slow, in their net income, they are almost close to going back to their pre-pandemic level. With this, their 10-year compounded growth is 3.73% in their revenue and 5.30% in their net income. In their equity, since 2012, they have grown consistently even during the pandemic. This is with a compounded growth of 6.78%. And as to how well they're managing their debts, their current ratio is only 0.98, missing that comfortable ratio of 1 that I'm looking for. This means they have 0.02 more current liabilities than their current assets, which isn't too much of a deal to me, since if you look at their debt to equity, they only have a ratio of 0.56, meaning for every 1 peso of equity, they only have 0.56 peso of debt, which is a very good ratio. Although their current ratio has more room for improvement, it only went down below 1 during the pandemic. In the previous years, they always have a current ratio above 1. For their dividends, this is what I like about Shang. They've consistently grown their dividends along with their earnings in the past years, and the only time it dropped was during the pandemic. But even though it went down, they still have a high dividend yield of 6.4%. So if they manage to recover, their yield would also increase along with it. And if you think they're giving away a huge amount of their earnings, well, their payout ratio is only 28%. This means there's still a lot of their earnings left to be reinvested into the company to grow its business. So for a dividend investor, it's an attractive deal for me. Now for price valuation, its PE ratio is only 4.5, and in comparison to its peers, it's really below the average price to earnings. And for price to book, it's only at 0.3, so we are buying its equity at a huge discount. And lastly, my computed intrinsic value for Shang is 3.69, and with a 30% margin of safety, my buy price is 2.58. So as of the creation of this video, it's a tight buy since currently it's trading at 2.59. The fourth company is Pure Gold, which I think most of us know this popular retail store, and they also own a share of another popular retail store, SNR. For their financials, revenue is consistently growing even during the peak of the pandemic. The only time they had a negative growth was in 2021, and for their net income, only 2017 had a slightly negative growth. Their 10-year compounded growth is 11.87% in their revenue and 12.61% in their net income. In their equity, they're consistently growing as well. This is with a 10-year compounded growth of 11.56%. And as to how they manage their debt, current ratio stands at 5.74, which means they have a lot of current assets at hand, which can well cover all their short-term obligations and debts. And for their debt to equity, it's low as well, only 0.74. This means Pure Gold is managing well their debts. For their dividends, Although in the lower bracket, it's still a good yield of 2.8%, and their payout ratio is at a very low 8% as well, which means most of their earnings are reinvested back into the company. And for their price valuation, PE ratio is at 9.8, and if compared to its peers, is trading below average. And you can see as well that its parent company Costco also has a very low PE. For its price to book, it's at 1.1, so slightly paying more for their equity, and in comparison with its peers, currently it's in the higher bracket. Again, their parent company Costco is only trading at a 0.4 book value. Lastly, my computed intrinsic value is 60.57, and with a 30% margin of safety, I have a buy price of 42.4. As of the creation of this video, Pure Gold is trading below my computed buy price. The last company is MegaWorld. This company has been hit hard by the pandemic. It dropped from a high of 6.14 pre-pandemic down to 2, and it's still trading at a very low price ever since. Looking at their financials, revenue-wise, they've been consistently growing pre-pandemic. Now I'm saying this even though they have some negative growth, but that negative growth is from a year with a one-off gain which happens sometimes in a lot of companies. Now for their latest 12 months, they are somewhat near recovery. They are already near their 2018 level. For their net income, same story but still far from the pre-pandemic level, although they recovered quite well in 2021. With this, their 10-year compounded growth is 6.30% in their revenue and 6.48% in their net income, which is not bad. For their equity, they've been consistently growing every year, growing at a compounded rate of 11.18% for the past 10 years, and as to how well they're managing their debts, current ratio stands at 2.98, which means they can definitely cover up all short-term obligations, and debt to equity is only 0.85, which is another good ratio for them. Now for their dividends, although their yield isn't high back then, but with their stock price dropping, their dividend yield now sits at 3%, which is a good yield. And as to how well they can maintain this, they are only paying 14% of their earnings to their shareholders, so I think they can easily maintain it. And the best part of their dividends, they grow it along with their earnings. They've been growing their payouts since 2013. For their price valuation, PE ratio is only 4.7, and comparing it to its peers, MegaWorld is in the low bracket. Price to book is only 0.3, and in comparison to its peers, is also very undervalued. Lastly, my computed intrinsic value is 4.57, and with a 30% margin of safety, my buy price is 3.2. So as of the creation of this video, MegaWorld is really trading below my buy price. So this ends this video for today. Again, please do your research before you even press the buy button. Don't solely rely on what other people say. Combine all the learnings you got from your research, videos, and what you got from Simply Wall Street to determine if you really want to invest in that certain company. So that's just a last reminder for everyone. If you learned something from this video and still haven't clicked the like button, then before you leave, do click it. It really helps out the channel. Thank you and see you in the next video.